Hi, I'm Doug Warren, and I'm going to take you through a brief demonstration to show you the functionality and how to use the Social Security Tax Torpedo presentation application. This app was designed as a demonstration tool that you can use during your seminars when you meet with clients individually. There's two reasons that we think that you're going to really like this application. First, it couldn't be simpler to use. And next, and probably more importantly, it'll make a big impression on your clients. There are four things that you can do with this application. They are to provide a brief but clear explanation of how the taxable portion of Social Security is calculated. You can illustrate the potential tax advantages of delaying the start of Social Security benefits. You can show the impact of the Social Security Tax Torpedo, and you can demonstrate how with advanced planning and the proper selection of retirement income vehicles that it may be possible to dramatically increase after-tax spendable income during retirement. There are only 4 possible inputs that you can enter into this program, and 3 of them are located here. To enter or change a number, place your cursor in the input field and click and drag to highlight the current number, and key in the new number and hit your Tab key to enter the new value. You can enter the retirement income, Social Security amounts, pension amounts that you want to use in your example. The IRA or 401k income is calculated by the program based on your inputs. For example, if you enter a total retirement income of $80,000, and of that amount you enter that $30,000 is coming from Social Security, the program automatically assumes that the remaining $50,000 would come from the IRA or a 401k. Now you're ready to explain how the taxable portion of Social Security is calculated. The income a person receives, in effect, goes into a bucket, and if it exceeds certain thresholds, a greater portion of Social Security is taxable. The thresholds shown will be appropriate for single or married couples, depending on your setting here. The program calculates and shows the amounts exceeding these thresholds. It also shows line by line the actual formula for determining the taxable portion of Social Security. The formula is actually fairly simple. It starts by determining the total combined income used in the example. Combined income is the total amount that ends up in this bucket. It is arrived at by taking 100% of the income from IRAs, 401ks, and other traditional tax-deferred retirement plans, and adding 50% of the income from Social Security. From this combined income, you subtract the first threshold in order to determine the excess amount. 50% of the amount exceeding the first threshold is taxable. You see that the program has calculated this here. Then you subtract the amount of the second threshold from the combined income to determine any excess over this amount. This excess is 35% taxable. Again, the program has calculated that taxable amount here. The taxable amounts on line F and I are totaled and appear here. The total taxable income is the total taxable Social Security plus the IRA or 401k withdrawals. Delaying the start of Social Security can often result in a reduction in the taxable amount of those benefits. This will be true for many people because the resulting larger delayed Social Security benefit often means that a greater portion of overall income will be coming from Social Security. The key to understanding how this can happen is due to the fact that only 50% of Social Security income is included in the calculations for determining the taxable portion of Social Security. Having to pay less tax on a larger delayed Social Security benefit seems counterintuitive and difficult to understand. Using this program to provide examples can help. We can see from the present example that if $30,000 of the total $80,000 of retirement income that we've entered comes from Social Security, that the combined income used to calculate Social Security taxation would be $65,000. That's arrived at by taking 100% of the IRA income and only 50% of the Social Security income. Because this combined income exceeds the tax thresholds by these amounts, the total taxable Social Security in this example is $23,850. Now let's increase the portion of the total income that we are assuming is coming from Social Security from $30,000 to $40,000. Even though the Social Security income is now larger, the total taxable portion has actually dropped. In case you missed it, let's reset the Social Security benefit back to the original $30,000. You can see that the taxable portion is $23,850. This is because the total combined income, or the amount that ends up in the bucket, is $65,000. But when you increase the Social Security benefit to $40,000, assuming we still have the same total income, the combined income drops from $65,000 down to $60,000. And the taxable portion of Social Security drops from $23,850 to $19,600 in this example. Perhaps of even greater significance is the reduction in total taxable income. Again, let's reset the assumed income from Social Security back to the original $30,000. Social Security, a person would need to withdraw more from their IRA to maintain the same total income. These IRA withdrawals are not only 100% taxable, but 100% of the amount is also added to the bucket, the combined income, which increases the taxable portion of the smaller Social Security benefit. The combination of these two tax hits means that of the total $80,000 of income, $73,850 is taxable. That is over $14,000 more taxable income than would be the case if the Social Security benefit was greater. Getting a greater Social Security benefit only requires that a person delays the start of the benefit. Whether or not this would in fact be a good strategy will depend upon the individual's objectives and circumstances. The point here is that it is not intended that this program be used to suggest that delaying the start of Social Security is always the optimal strategy. Instead, the purpose of the program is to demonstrate that there may be tax implications to the timing of benefits which should at least be considered. Another important tax consideration is what often is referred to as the Social Security Tax Torpedo. Income hit hardest by this tax torpedo are the amounts that exceed the top threshold for Social Security taxation. To illustrate this, click here and the bucket is replaced with the yellow section you now see on the right. The numbers in this yellow section are identical to the tan section on the left, with the exception that the yellow section assumes one single additional dollar is withdrawn from the IRA. A great feature when you're in this section of the program is that as you place your cursor on the left-hand side over any row of numbers, the program will automatically highlight that row. This allows you to focus the viewer's attention to any numbers you might be discussing. The easiest way to initially explain the potential impact of the tax torpedo is to again illustrate what happens if only one additional dollar is withdrawn from the IRA. The total income is only $1 more. But when we compare the total taxable income, we see that it is actually increased by $1.85. That's the tax torpedo. You withdraw one extra dollar. When that $1 is in excess of that top threshold, it actually creates $1.85 of taxable income. If you like, you can take your seminar audience or your individual clients through the actual calculations line by line to show how this happens. And the challenge is that you really can't overcome this problem by taking greater withdrawals. For example, assume that a married couple in this situation wanted to take a cruise or a dream vacation that will cost $10,000. To demonstrate the impact of the tax torpedo on this larger amount, simply enter $10,000 here. We see that the total income has increased by $10,000, the amount that we entered. But we also see that because of the tax torpedo, the taxable income increases from $59,600 to $78,100. That's $18,500 more of taxable income. Again, total income has only increased by $10,000, but taxable income increased by $18,500. How much will be left after paying the extra taxes? Likely only a fraction of the $10,000 that was withdrawn and needed for the cruise or the dream vacation. More could be withdrawn from the IRA to make up the difference, but because of the tax torpedo, the problem might only get worse. Of particular significance when considering Social Security taxation is the understanding that it may be possible, with advanced planning, to create income streams from sources that are potentially not counted in the Social Security tax calculations. Income from things like qualified distributions from Roth IRAs, withdrawals and cash value loans from permanent life insurance, reverse mortgages, and a few other items can fit into this category. What we want to demonstrate is the impact of replacing some of the income from, say, a traditional IRA with income from one of these tax-advantaged sources. Enter $10,000, for example, and the program will automatically assume that the withdrawals from the traditional IRA would be reduced by that same amount. The result is a dramatic reduction in both the taxable portion of Social Security as well as the total taxable income. In case you didn't see it, let's reset by entering 0 here. We can see that without this source of tax-advantaged income, the taxable portion of Social Security is $19,600, and the total taxable income is $59,600. But with $10,000 of tax-advantaged income, the taxable Social Security reduces to $11,100, and the total taxable drops to $41,100. This is a much more dramatic reduction than most people would expect, which means that the value of having a source of tax-advantaged income is much greater than just the $10,000 we're assuming in this example. What this program illustrates is that the value of having $10,000 of income from a Roth IRA or permanent life insurance withdrawals and loans is potentially much greater from a tax savings perspective than simply a $10,000 reduction in taxable income. In this example, this $10,000 actually creates an $18,500 reduction in taxable income. This is the tax torpedo in reverse. Knowledgeable advisors working with the client's tax professionals can play an important role in educating clients as to the pitfalls and opportunities related to the potential impact of Social Security taxation. This program is a quick and easy way for demonstrating these concepts to your clients.